Okay, welcome back. So the air in the financial markets this week, starting November 3rd, 2025, it feels incredibly thick, doesn't it?
It really does.
Yeah.
We're not talking steady climbs here.
No, definitely not. It's more like a high stakes environment, just
Hmm.
pure volatility.
Hmm.
So today, we're going to try and cut through some of that noise. We'll use your sources to give you, the listener, a clear map of what's actually driving things. We're looking at tech and pharma earnings, those heavyweights, and that really crucial private sector jobs data.
And the setup, I mean, it's classic tension, right?
Totally. You've got the S&P 500 sitting right near record highs.
After that huge AI rally.
Exactly. But, if you look just beneath the surface, you can definitely see some cracks starting to show.
Yeah.
We saw a perfect example just recently, right? Palantir.
Oh, yeah.
They reported really stellar results, a big beat on revenue, and the stock still took an immediate tumble after hours, over 6% down.
And that Palantir dip, it really highlights the core issue this week, doesn't it? Why did it fall, even with a beat?
Yeah.
It's because those expectations, I mean, they were just astronomical, completely fueled by the AI hype machine. These earnings reports, from AMD, from Palantir, they aren't just numbers on a page.
No.
They're the real-world stress tests. Is this AI boom actually grounded in, well, reality?
And the stakes are huge when you look back.
Oh, enormous. Remember 2024? The NASDAQ surged, 46%?
Yeah, massive.
Almost entirely powered by tech earnings. So this week, it feels like it's shaping up to echo that kind of high-stakes drama. And all the while, you've got the jobs report looming.
Had jobs report.
It influences everything. I mean, everything from Fed interest rates to, potentially your next pay raise.
Okay, let's unpack this then. First up, probably the most important bit, the AI showdown. Tech is just dominating.
Over 30% of the S&P 500. You can't ignore it.
Right. And its performance drove that huge 25% gain in the NASDAQ year to date. So when tech reports, the whole market kind of holds its breath. And the real focal point this week, I think, is AMD. They report on November 4th. Analysts are expecting pretty healthy results, right? Q3 revenue around $8.74 billion, EPS of 1.6 cents.
Yeah, that's the consensus. It would be a solid 20% jump year over year, mostly thanks to demand for those MI300 AI processors.
But the number to watch isn't just that headline figure, is it?
No, not at all. The crucial metric here, the real story, it's the fight with NVIDIA.
Ah, the market share battle.
Exactly. NVIDIA has, like 80% of the AI GPU market? It's huge dominance.
So the test for AMD is basically, are they making a dent?
Precisely. Are they actually chipping away at that dominance? That's what investors need to see.
And what specifically proves that? What number are we looking for?
It's their data center sales. They need to show really aggressive growth there.
Okay.
If those sales hit, say, $4.5 billion, that's a 30% jump, that would signal they're making real competitive inroads.
And that kind of surprise can really move the stock.
Oh, absolutely. Think about, industrial stocks. Deere Company popped 12% once on a surprise beat in farm equipment sales. AMD's kind of looking for that same energy, but in the data center space.
Okay, so strong data center sales are key. But then there's the guidance.
Always the guidance. The market is relentlessly forward-looking.
So if CEO Lisa Su even hints at Q4 revenue around, say, $9.5 billion.
Then yeah, the shares could genuinely test that $180 mark. It implies huge confidence in their long-term growth path.
And it's that future path, that trajectory that kind of tripped up Palantir, wasn't it? Even though their current numbers looked amazing.
Exactly right. They reported November 3rd, hit $1.18 billion in revenue, smashed estimates 63% overall growth.
And their commercial side.
Soared. Commercial revenue up 54%, really driven by those AIP platform deals. Look fantastic on paper.
So why the immediate 8% drop after hours? If they beat, why did the market react like that?
One word, valuation. Or maybe two, valuation debt.
Okay.
Palantir was trading at something like 445 times earnings.
Wow, 445.
Yeah, it's dizzying. For every dollar of profit, investors were paying $445 for the stock. That premium is built entirely on future hope, not current reality.
So Wall Street had priced in perfection, and then some.
Pretty much. They essentially demanded 60% growth guidance for Q4 to justify that crazy multiple. And Palantir only delivered an implied 50%, so boom, correction.
So the market basically said, nice quarter, but not nearly nice enough to justify this price tag.
That's the gist of it.
Does this mean investors are souring on AI hype overall, or is it just a healthy reset for one company?
I think it's probably more of a healthy correction, actually. You look at the core signals for Palantir, they're still strong.
Like what?
customer count is up 25%. That commercial revenue growth, that's real sector engagement. It's healthy.
Okay.
The big question longer term for investors is whether those commercial deals can grow fast enough to eventually, stabilize and maybe even surpass the revenue they get from those big but sometimes lumpy government contracts.
Right. Diversifying that revenue stream. Okay, let's pivot sharply now. We've talked high-flying, volatile tech. Let's move to a really critical defensive sector, pharma.
Good idea. Pharma is almost the necessary counterweight to all this tech volatility. It's defined much more by stability, resilience.
A huge spending.
Massive. Healthcare spending is, 18% U.S. GDP? It's around $4.5 trillion.
Wow.
But interestingly, the actual pharma index, it's lagged the broader market this year by about 15%.
So there's a gap there.
There is. And that gap makes this week's pharma earnings a really big test of that foundational stability. Is it still a reliable defensive play?
Leading the pack here is Pfizer, reporting November 5th. Post-COVID, it seems their focus has really shifted.
Entirely. It's all about their RSV vaccines now and their oncology portfolio. Consensus is looking for about 0.698 EPS on roughly $15.5 billion in sales.
And their strategy seems very defensive.
It's a masterclass in defensive strategy, really, because they're facing a huge headwind.
The patent cliff.
Exactly. Patent expiries are looming for about 20% of their current portfolio. That's significant.
So what's the counter move?
Aggressive cost management and pipeline bets. They're implementing a hefty $3 billion cost trim.
$3 billion.
Yep. And they're aiming for $4 billion in synergies from that big Seagen acquisition they made.
So it's all about squeezing efficiency out of the current operations.
To buy time. Exactly. Buying time for their massive pipeline, over 100 assets in development to deliver the next generation of blockbuster drugs.
It's a totally different kind of pressure cooker compared to the market share fight AMD is in.
Completely different dynamic, and you see this push for stability across the sector too. We're also watching Vertex this week.
Right, cystic fibrosis drug.
Yeah, driving about 15% growth there. And Amgen is another one, pushing hard into biosimilars.
So if these big defensive names, Pfizer, Vertex, Amgen, if they perform well together,
it could give a nice lift, maybe 2% to the XBI Biotech Index. And that would really confirm pharma's role as an essential hedge if, the AI excitement pulls back significantly.
That defensive strength is definitely reassuring for some investors. But, here comes the wild card, the thing that could disrupt everything we've just talked about.
Always a wild card.
The macro picture. Specifically, the ADP private sector employment report. That drops Wednesday morning, November 5th.
Yep, 8:15 a.m. Eastern. And expectations are tense.
After September showed that worrying loss of 32,000 jobs.
Yeah, that was a shocker.
The market is really hoping for a rebound. The projection is for 31,000 jobs added in October.
And this report, it's the critical link, the direct line to what the Federal Reserve might do next.
Explain that connection, if the number is soft.
Okay, so if it comes in soft, fewer jobs than expected, maybe even negative again, it suggests the economy is cooling down like the Fed wants.
Right.
And a cooler economy often gives the Fed the green light to start cutting interest rates.
And lower rates are generally good for stocks, especially growth stocks like tech, right? Why is that again?
Two main reasons. Lower rates mean cheaper borrowing costs for companies looking to expand, and maybe more importantly for these high flyers.
Like Palantir at 445 times earnings.
Exactly. It means their future earnings, which are the only justification for valuations like that, are discounted less heavily today. Lower rates make future profits seem more valuable right now.
Okay, got it. So conversely, if ADP surprises everyone with a strong number, say 50,000 jobs added, maybe more,
then that whole narrative about imminent rate cuts gets pushed back, delayed.
Okay.
And that puts immediate pressure right back on those highly valued growth stocks. The air comes out of the balloon a bit.
And we've seen this play out before.
Oh, yeah. The market reacts instantly.
Yeah.
Last time ADP came in unexpectedly strong, Treasury yields spiked, 10 basis points? Almost immediately. Financial conditions tightened on the spot.
So this single report can really drive market swings.
Definitely. You should probably be prepared for maybe 1% to 2% daily volatility this week, driven almost entirely by the tone of this jobs number. It's that influential.
Okay, so jobs data is huge. We also wrap up the week with a couple more important consumer pulse checks, don't we?
We do. We're watching Uber. They need to show their growth story is still on track. Expected EPS is around 0.58 cents on about $10.5 billion in revenue.
And the key metric there.
Keep an eye on their monthly active users, their MAUs. That gives you a really good sense of consumer spending health, especially in service sector.
And then we finish the AI chip parade.
Yep, rounded out with Qualcomm and ARM Holdings, if they both report continued strong demand for AI chip infrastructure.
Which feeds back into the whole AI boom narrative.
Exactly. Positive results there could collectively push the entire chip sector's market cap past the $2 trillion mark. It's kind of the final structural check on the AI theme for this intense week.
Wow. What a week indeed. It really feels like fireworks are guaranteed. You've got these AI showdowns, AMD versus NVIDIA, Palantir versus its own valuation, colliding with that stability test in pharma, and hanging over all of it.
Yeah.
Is the labor market dictating the Fed's next move?
Yeah, it's a lot to track. But the synthesis, I think, is becoming clearer. In an environment this volatile, this uncertain, the immediate earnings beat or miss, it's actually less important than the company's guidance, their outlook, their story about the future.
The Palantir lesson.
The Palantir lesson, writ large. The market cares way more about the trajectory, the path towards the promise, than the score of the current quarter. You need to watch that forward guidance like a hawk.
So looking ahead, we've seen the S&P eyeing, what, 5,900 if this earnings momentum holds?
That's the target some analysts are putting out there, yeah.
But let's just circle back to that tension we unpacked.
Yeah.
You've got these massive, almost unbelievable valuations, Palantir, at 445x earnings, driven entirely by this belief.
This hope.
This hope that, $200 billion in AI spending is definitely going to materialize by 2026.
Right. And that forces a really crucial long-term question for you, the listener, to think about.
Okay, lay it on us.
If that massive AI spending wave, if it doesn't fully materialize as expected, if the hype machine slows down even a little bit, you have to ask yourself, which fundamental sector is the true keeper for long-term value? Is it the super high-valued, maybe speculative tech giants? Or is it the cost-efficient, resilient, defensive pharma companies?
Tech versus pharma in the long run, beyond the hype.
Exactly. Which one provides the real bedrock for value creation when the dust settles? That's the strategic question to chew on as you watch all of the volatility unfold this week.
Yeah.